proceed to Chapter 8, Selling. So the first question is, what is selling and its importance? So selling is a process of offering goods or services in exchange for money, typically involving communication between a seller and a buyer. It includes identifying customers' needs, presenting a product's values, and closing a sale. Selling is crucial because it drives revenue for businesses, helps in customers' relationship building, and ensures that products or services reach the right customers. Effective selling techniques can also differentiate businesses from competitors and increase customers' loyalty, ultimately contributing to business growth and market success. And next is how to and the second one is how to formulate the selling price. So the selling price is determined by considering various cost factors and market influences to ensure profitability while remaining competitive. Factors to consider in setting the selling price is first is the cost of goods sold, or COGS. So the total cost of production including raw material, labor, and overhead expenses. Second is the desired profit margin, the amount of profit the seller aims to make on each sale. And the third one is the market competition, comparing prices with competitors to stay competitive. Number four is the customer demand. Higher demand may allow for premium pricing, while lower demand may require adjustments. Number five is operating expenses. So fixed and variable costs like rent, salaries, and utilities should be covered. Six is economic conditions. Inflations, taxes, and purchasing power can impact pricing decisions. Number seven is psychological pricing strategy, such as discount pricing, premium pricing, and value-based pricing to attract buyers. So the general formula for setting the selling price is selling price is equal to total cost plus markup, or selling price equal to cost plus markup percentage. So markup versus markdown. So markup is a percentage added to the cost of productions to determine the selling price. It ensures the business earn a profit. While markdown is a reduction in the original selling price, usually due to low sales, excess inventory, and seasonal changes. When to markdown. So products are not selling at the expected rate. To clear out old inventory before introducing new stock during promotional sales or special event. If competitors lower their prices, requiring adjustments to remain competitive. When a product reaches the end of its life cycle or becomes outdated. So number four is simple problems with solutions. So markup based on cost. So a business purchases a product for 500 pesos and applies a 40% markup. What is the selling price? So the formula is selling price is equal to cost plus markup percentage. So the solution would be selling price is equal to 500 plus is equal to 500 parenthesis 1 plus 0.40 close parenthesis. So 500 times 1.40 is equal to 700. So the answer, the selling price is 700. And for the markup based on selling price, a store sells a product for 800 with a 25% markup based on the selling price. What is the cost of the product? So the formula is a cost is equal to selling price times 1 minus markup percentage. So the solution would be 800 times 1 minus 0.25. So the answer would be 600. Now for markdown with product, a product originally priced at 1000 is marked down by 20%. If the original cost is 700, is there still a profit? So new price is equal to original price times 1 minus markdown percentage. So so new price is equal to 1000 times 1 negative 1 minus 0.20. So the answer would be 1000 times 0.80, and the final answer is 800. So profit calculations would be new price minus cost. So 800 minus 700 is 100. So therefore, there is still a 100 pesos profit after the markdown. So markdown with operating loss. So a product originally priced at 2000 is marked down by 30%. The cost of the product was 15 and operating expenses were 400. What is the financial result? So new price is equal to 2000 times 1 minus 0.30. So the answer would be 2000 times 0.70 is equal to 140. So the total expenses is equal to costs plus operating expenses would be equal to 1500 plus 400 is 1900. An operating loss is equal to total expenses minus new price would be 19 minus 1400 is equal to 500. So the final answer is the business incurs 500 operating loss. So E. So markdown with absolute loss. So a product originally priced at 600 pesos is marked down by 50%. The original cost was 400. So the solution would be new price is equal to 600 times 1 minus 0.50. 0.50 is equal to 300. So the absolute loss is equal to cost minus new price. So the answer would be 400 minus 300 is equal to 100. So the final answer is the business faces 100 pesos absolute loss. So these calculations help businesses set profitable prices, adjust to market changes, and manage financial performance effectively. So that's all.